to the point where, well, they shut them down because they said that they aren't actually providing them with the information that they were designed to provide them with. But then obviously there's people that have other kind of conspiracy theories about it. Basically what happened was these two robots actually developed a language that they were using between each other that the Facebook programmers couldn't actually read, right? So obviously, like, there's some conspiracy type theorists that believe that this is bad because the machines were learning how to communicate without any human intervention or human ability to determine exactly what they were saying. But here's a quick video that explains all of this. And a lot of people think that this is actually why Facebook shut down the program. But Mark Zuckerberg is adamant that this had nothing to do with it. So we'll see.
Facebook has enacted an emergency shutdown of 2 artificial intelligence programs. The social media giant leapt into action after it discovered the 2 programs were writing their own code. At first they thought it was simply gibberish, but they soon realised the programs had invented their own language and were actually talking to each other.
Stop it.
Stop it, no.
So you can see here, Bob and Alice are the 2 programs, and then everything is going well before. You can see here, they're like repeating lines, the word eyes here several times. They put 0 in. So obviously at first the programmers thought that this was just the machines breaking down. But then when they started to analyze it deeper, they found that this is actually a shorthand that the machines had come up with. And the idea here, what they were looking into, was using the 2 machines to determine best practices for negotiation. So the idea was that the machines were going to negotiate over an imaginary product in a way that humans would, so that they could analyze how negotiations work.
Sam, the plug has been pulled on the operation, but the company admits they have no idea what the 2 robots were planning.
We used to do everything by hand. Now we rely on robots. But not all robots are equal. For example, meet Sophia, a humanoid-like robot with artificial intelligence and a dark sense of humor.
They think I want to destroy all humans.
Why would they think that?
Because I said it?
Now, robots threatening the human race isn't new. It's a science fiction standard.
I know that you and Frank were planning to disconnect me.
But recently, tech billionaire Elon Musk suggested all that fiction could become reality.
I keep sounding the alarm bell, but until people see like robots going down the street killing people, like they don't know how to react.
And Musk should know his company Tesla is a world leader in artificial intelligence, or AI. But just like robots, not all tech billionaires think the same. So enter Facebook founder Mark Zuckerberg.
With AI especially, I'm really optimistic. And I think that people who are naysayers and kind of try to drum up these doomsday scenarios are I don't understand it. I think it's really negative, and in some ways I actually think it's pretty irresponsible.
Musk's response? Zuckerberg's understanding of the subject is limited. Ouch. Now, it's important to note that 2 billionaires have a history. This was Musk's rocket. Inside was Zuckerberg's satellite. So when it comes to AI, Zuckerberg looks at how it can help diagnose diseases and prevent car wrecks. Musk is afraid of the day AI gets smarter than us and we can't turn it off.
That's actually the nightmare scenario that a lot of people, not just Musk, are warning about. And I think they're right to warn about it, but they're not right to do it in a way that says, therefore we shouldn't create artificial intelligence.
So in a way, they're both right. They just let those human emotions get the better of them.
So there you go. For those of you who don't know who Elon Musk is, he's the founder of Tesla, and he pours a lot of money into doing futuristic research. Like, one of the projects he's working on is the Hyperloop, which is like a sort of like high-speed transportation system where people like are transported in pods. So he's pretty cutting edge. He's pushing the limit of what's possible with things like, you saw his rocket blowing up. I guess that was a pretty unfair representation, but he is pushing like space exploration a lot and things like that. So it's a debate, it's real. Like, you guys weren't just learning it in class for not to be a apply to the real world. Like, these people are billionaires at this point, and they're still like unsure as to what's going to happen. So that's enough about artificial intelligence. Let's get to today's discussion, which is the audit, right? You guys have indicated to me that you don't know too much about auditing itself. So today we're going to go over the actual process of an audit, what happens, what the different types of audit opinions are, and in the process of doing that, I'm also going to go over some stuff that actually apply to this class. Not only how the different things that you've been learning about fit into an audit, but some things about sampling, which is something you guys need to learn about because it's what's used out there in the real world. So pretty much let's start off by looking at why we need audits, right? So if you guys remember back in the beginning of this semester, I guess, I started off by introducing you guys to some of the history of accounting and the history of why audits came about. Briefly, pretty much, accounting was originally invented by this guy, Luca Pacioli, and he was a mathematician in Italy back in the Renaissance, and he came up with this idea of double entry accounting and double entry bookkeeping, the idea of credits and debits, which you guys are now all familiar with. And that way, there's a way of keeping track of all the financial information that you know has to be correct. Where every credit, there needs to be a debit of some sort. They all need to balance out, right? So he came up with this idea, and it was used for accounting, but auditing still wasn't a thing, right? And then what happened was, during the wave of exploration that occurred, like when people discovered America and shipping was like, the Dutch East India Company was like really famous and all that kind of stuff, what was happening was a lot of these companies were misreporting the amount of trade that they were actually conducting, right? So investors needed to know that the money they were investing into these trading companies was actually being invested properly, and the returns that they were expecting or being told that they were going to get were actually coming in. They needed to know what areas were profitable and what areas were not, right? So that was the birth of the idea of actually auditing, right? And what you had was you had companies that would go in and verify what the traders were telling the investors. These were the original auditors, effectively. But auditing wasn't mandated or anything like that. Then what happened was you had famous stock market crashes, and in the early days of the stock market, there was pretty much no regulation. And what ended up happening was a lot of people were creating dummy companies just to get people to invest, and then they were running away with the investment money because there was really no accountability in those days. So the government had to step in, and what they did was they created this idea of a formal audit where people would come in every year, assess the finances of a company, and the original audits in those days were literally just to prove that the company existed and it was doing what it says it does. There were no ideas of misrepresentation of financial information. I'm sure in a broad sense that it existed, right? Because you need the company to be doing what they say they're doing. And obviously if they say they're doing $1 million worth of sales and they're doing like $10,000 worth of sales, an auditor would probably note that. But most of the formal audit laws that we have, unfortunately for investors, are reactive, not proactive. So it's only come about that all these different laws that affect auditors came into being simply because there were big financial collapses or big investor losses that occurred as a result of these errors on the part of the auditors. So then financial oversight boards would require auditors to do different things. So in recent times, we have two major government acts that have affected auditing, right? There's the Sarbanes-Oxley Act, which has done a lot. It, among other things, it requires things like the tests of internal controls and things like that. That came about, as I mentioned earlier, because of the collapse of Enron and the inability of Arthur Andersen to correctly audit Enron. As far as the regulators and the public were concerned, they didn't do a good job, right? Auditors are supposed to be independent because they're verifying the information that's coming. So a lot of Sarbanes-Oxley deals with those kinds of things. And you have the Dodd-Frank Act, which doesn't really target auditors specifically. It targets financial institutions, but it it also impacts auditors, right? So the Dodd-Frank Act, what it does, it was a response to the Great Recession, right? That's what we're calling it now, that happened in 2008. And basically the idea here, in a nutshell, is people were buying houses that they couldn't afford, right? That in itself doesn't have anything to do with auditors, and it doesn't have anything to do with major companies. The problem was people were doing these things called credit default swaps. And what a credit default swap is we take all of your loans, because what happens is when you take out a loan from a bank, the bank doesn't hold that loan. It sells that loan to another company so that they can be more liquid and they can have money coming in more than just your loan income on a regular basis, right? So they classify all the different loans into different brackets, right? So you have bracket A, which are the best loans, for instance, and you have bracket B, which are slightly worse loans, and then you have bracket C, which are the worst loans, right? High risk of default. And theoretically, mortgage brokers who are selling the mortgages to these people are supposed to be giving the mortgages and classifying the people with different interest rates correctly, right? But that wasn't happening, and that, to be honest with you, still doesn't happen, because mortgage brokers make a commission on closing a loan. They don't really care if you pay the loan back, they just need to make a commission on closing it. So then what happened was people were looking for cool ways to trade things, and when they were selling these off to other parties, what they would do is say that these people in group C are high risk. No one really wants to buy these loans from the banks, so we have to find a way to sell them. So what they did was, instead of selling all A, they would bundle them, right? So you would get a package that was a combination of all three loans. All right? The problem is, how do you value the risk of this package? It's very difficult to do because you don't really know what kinds of loans are going into the package, and even then, you don't know if these loans are classified correctly, right? So then what they did was they took these packages and they actually ended up splitting those packages up further, right, into smaller packages or combining them into bigger packages. Either way, the point is you just keep getting combinations of these three different stratospheres, and people had no idea how to value these, okay? Then you sell these on to a financial company that is, call it like, let me think of a good one, like Bear Stearns, for instance, right? Quite a bit accurate for Bear Stearns, but anyway. Bear Stearns buys up all of these credit default swaps and they're trading on them. They're betting that whatever money that they pay for these loans, the loans when they come in are going to be paid off more than that, right? And they're betting that the chances of all of these loans failing are really, really low, okay? But they don't actually understand the true value of whether or not these people are high credit risk or low credit risk. They're just betting that when it was given to them, it was assessed correctly, which didn't happen, okay? So then what they're doing is Bear Stearns takes this, Bear Stearns repackages this, and sells it off to someone else. And pretty much you have this whole like interconnected web of financial institutions that are trading these bad loans around, right? Which is all fine until people stop paying their loans, right? So when people stop paying the loans, the money stops coming through to Bear Stearns. Then Bear Stearns is like, holy crap, people aren't paying their loans back, we need to try to sell this to someone else. So Bear Stearns tries selling these credit default swaps off to someone else. The problem also was they were able to leverage this into more money than it was actually worth by using complicated financial stuff that I'm not really going to go into. So basically, even though they had, say, $1,000 worth of guaranteed money coming into loans, they were going to the bank and they were saying, these loans are supposed to be really good. So we can use these as collateral and we can trade like $10,000 worth of loans, right? Even though they don't have the $10,000, they're using this as collateral to say that, all right, the chances of these loans going bad are so slim that we can trade on $10,000, we'll make some money off the $10,000, and if we have to pay, we have the $1,000 collateral, and we can come up with the rest if we need to, right? Then the problem is, like, this money gets totally wiped, right? So then Bear Stearns is like, holy crap. So in the end, what basically happens was you have this interconnected web of financial institutions, all the loans start going bad, and they realize that they've leveraged their debt to a point where they actually are going to go under because all of these loans are bad. And so you have the housing crisis which happens, and they create these financial problems. Then for those of you who haven't seen it, watch Too Big to Fail or read the book. It's really good, it's really interesting. People made a lot of money off of this because they knew that credit default swaps were probably a bad idea and that loans were probably going to go bad. What's the name? The Big Short, right? That's the name of the book that focuses on this. They made a movie about it too. Steve Carell's in it, right? But it's not a comedy. It's actually a drama, and it's super serious and sad. But anyway, the point of telling you about this is because this is what causes the creation of the Dodd-Frank Act, right? And one of the key provisions of the Dodd-Frank Act directly impacts auditors because now companies have to undergo what's called a financial stress test. Auditors need to come into these finance companies and they need to make sure that if there is some great failure somewhere in their liquidity base, that the company is able to withstand that financial pressure. So the idea behind why people want to know about an audit, why people want to make sure that these companies are too big not to fail, hopefully, is because it's not just investors, right? So who needs this audited information? Who needs to know that the company is going to survive these financial stress conditions? It's investors, of course, right? Because their money's invested in the company. But it's not only investors, because it's potential investors that might want to buy into the company. It's business partners who might want to interact with the company. It's employees of the company, right? And this is really important because this ties in with investors. Employees and investors are not just Wall Street brokers. These are people that have their pensions tied up in these companies. The other problem is you have companies that are inter-invested in one another, right? So this is the idea of too big to fail. When these companies have so much money in them, so much worth stored in them, then when you let them fail, not only will it take down all the pension plans of the people that are invested in the company. Like for example, when Enron failed, a majority of the people that were affected, yes, okay, employees lost their jobs, managers lost their share because they had like share equity built up in the company as part of their bonus packages. But more importantly, it was believed to be such a secure company that people were investing their entire pension plans into this company. And those are the people who were affected most. The people that were like 60 years old, that had no more income coming in, and were banking on the money coming in from Enron for the rest of their life to get them through to death, right? So the government said, all right, we can't have this happen anymore. It came up with Sarbanes-Oxley, then with Too Big to Fail, and they said, we really can't let this happen. The other problem with the too big to fail scenario is that if one of these banks go down, it causes almost a run on the other banks. A run is when people lose faith in the bank and they want to withdraw all their money. So in the case of an investment fund, they're going in and they're withdrawing all of their investments from the company. And this will cause the price of the stock to spiral down. Then more people will go in and try to pull money out as quickly as possible because they don't want to be the biggest loser. And next thing you know, the entire company is worth almost nothing and it has to totally liquidate all its assets and sell off to another company or just go under, okay? So this is why audits are incredibly important because the money is tied up into so many different aspects of society that you need to make sure these big corporations are behaving responsibly and presenting themselves in an accurate way. What we're going to learn about at the end of the lecture today is that not only do auditors issue an audit opinion saying there's a material misstatement or no material misstatement, but they also have the prerogative to issue what's called a going concern opinion. And a going concern opinion is basically the auditor saying, all right, all the information being presented by management is good, but we have a high likelihood of believing that within the next year, the company is going to go under, right? If you're a company, that means like you have a clean audit, right? You didn't actually do anything wrong, but the auditors have said you could be in financial distress. And we're going to learn about the problems that that can cause and the different things that go on with that. But basically, the auditors here, they're not providing any new information other than information on whether it's presented accurately or not, or whether they personally feel that the company is going to go under. Now, this is obviously stuff the investor can deduce on their own, but the government felt it prudent to include this in an audit setting with a going concern opinion because most of the general public doesn't have the financial know-how to read the financial statements and draw these conclusions on their own, right? So they use the auditors to do that. So these are kind of the people that use an audit, and this is why an audit is so important of publicly traded companies, especially the large ones, right? So basically, this is an overview of the audit process. We're going to go into a little more detail about it, but it begins with the obvious, which is a negotiation over the price, right? So you have to go in, you assess how big the company is, what your costs are going to be, what kind of experts you might need to bring in, because it could be a specialized company in a specialized industry that you may not have the knowledge about or have done an audit on that kind of a company before. So this is kind of like before the audit starts, but they're already doing some assessment of the corporation to kind of get an idea of what their cost is going to be, right? But obviously their cost could be much greater or much smaller based on what they find, so it's not a set cost until they deliver at the end of the report. The next thing that they do after they agree upon this is they access the prior year's audit information and some of the basic financial information, right? When you're conducting an audit of a company, they have to supply you with whatever you're asking. They have to help you. If you need any kind of explanations, they're required to give that to you, right? This is why management hates audits, because not only are they going to detect any problems, but they're also going to just bother you, right? Under Sarbanes-Oxley, audit, so the person in charge of doing this audit is an audit partner, right? And they are the main liaison between the upper management of the company, the audit committee, right? The audit committee is basically a committee founded by the board of directors, and what they're supposed to do is oversee the audit process from a shareholder point of view. And so when you deliver the final results, you don't really give it to management. I mean, yes, you do, because you want management to know, but your primary concern is giving that information to the audit committee, because they're the ones who really need it, right? We've talked over and over again about this information asymmetry problem that exists, where management knows more about the company than the shareholders do. And part of why we conduct an audit is to reduce that information asymmetry and make sure that management is doing a good job of presenting that information and following the rules, right? So the auditors are not really beholden to management, they're more beholden to the shareholders and the audit committee. So they get all this information and they come up with an audit plan, right? Most of the tests that we've spoken about over the course of this course are used during the audit plan stage, because what they're doing here is they're doing a basic analysis of the company and all of its financial records and all the potential risks, and they're coming up with an exact plan of how they're going to conduct the tests, what types of tests they're going to conduct, what types of levels are constitute material or immaterial misstatements, that kind of thing. So once they do that, they actually conduct the field work that involves everything from testing the accounts, doing matches, going to inventory warehouses and verifying that. And then what they do is when they detect any major problems, they bring it to the attention of management and the attention of the audit committee. And they tell them, look, you guys either have to fix this or we're going to issue an adverse opinion, or what's more likely to happen is that they're going to drop the audit, right? Because if management might refuse to do it, and in that case, nobody wants to issue an adverse opinion. I mean, auditors are willing to do it, but management doesn't want it to happen, so they usually think, all right, another auditor won't do this, so usually they try to change auditors. Even if you change auditors and a new auditor comes in and doesn't give you a qualified opinion, which is like an adverse one, then the market can still tell that you switched auditors. Because when you switch auditors, you have to fill out a public disclosure form. And what that says is you switch auditors, you're supposed to include the reason for switching auditors, but the go-to reason is cost, so that they don't really have to give away too much information. But if it's in the middle of audit season and the market sees that you switched auditors, they know that there has to be a very good reason why that happened. And chances are it's because you're trying to cover something up or you had a disagreement with the auditor. So already that is giving the required signal to the market, which is the point of doing an audit, right? So once you bring the major problems and hopefully they all get settled, you form your opinion and you present all of your information to the audit committee and the management. And once that's done and everyone's happy, you issue your formal public audit report. And those we're going to go over, but they're very boilerplate. They all look exactly the same. And it pretty much just says within a reasonable, we have like a reasonable assertion that all the financial statements are presented in a fair and accurate manner, right? That's pretty much it. So that's a brief overview of what we're going to discuss. So initially what happens once they've negotiated the price and they're moving in to start the audit, they start the preliminary stages, which is like the notification and initial requests. So during this stage, what they do is they make it known to the client and to the management, like they're going to be the ones that are going to perform the audit, and they request basic financial information, past audit information, financial statements, which they already can get access to, and pretty much what they're doing here is they're trying to gain some basic understanding of the business's operations, because even if the auditors have done plenty of audits in this specific industry, every company is different, just like every person is different. So they need to learn what areas are high risk, what areas are low risk, where there might be misstatements, even what types of financial accounting practices the company uses, all this kind of stuff, right? So what kind of data do they take? They take prior year audit information, they take a general look at the ledgers, they do some of the statistical sampling and descriptive statistics that we spoke about in the beginning of the semester. They look at bank statements, all this kind of information. They look at who the company does business with, who the major suppliers are, all this kind of stuff, right? And basically the purpose of doing this is to plan the audit, okay? So when the planning stage occurs, the auditors are drawing on this information and then subjectively coming up with tests and risk areas that they want to evaluate over the course of the audit, right? The main important areas that we're going to discuss with this are the following. So the tone at the top, this is really important, which involves like how management runs the company. Important accounts, which they're looking to identify. So what are major value accounts that we really need to look into and test? Materiality thresholds, because every account is slightly different. What constitutes a material misstatement versus an immaterial misstatement? Obviously, we expect that there's always going to be some error, right? People make errors entering numbers, people make mistakes, there are double entries of certain instances or transactions. All these things naturally occur, especially in a really large business. So what they're looking at is, when does that cross the line of being too much for it to just be an innocent mistake? Even if it is an innocent mistake, it can still cause a big difference on a financial statement. And at that point, they can't say that there's a reasonable assurance that it's presented fairly, because it's not, right? So they gotta fix it. They also look at areas of business risks. Like I keep mentioning, which accounts are risky. In not only which accounts are risky, like one element of this is what type of industry does the business operate in, and what are the risks associated with that business. For example, we spoke a few minutes ago about how financial industry companies need to undergo this stress test, right? That's an example of an industry risk. They might have a liquidity concern, but something like Delta Airways may not have the same kind of liquidity concern. There may be other risks associated with that. Like, for example, one risk might be the risk of fuel spiking, right? That could have a huge impact on how they operate their business. Is Delta actually disclosing that information correctly on their financial statements? The next thing is like tolerable audit risks. Because obviously, since we don't live in the future that Rutgers would like it to be, right? We're not doing full population testing in an external audit. We're not doing continuous auditing in an external audit. We're doing sampling, right? Which I would argue is an inferior way of doing things. So there is a great risk that there may be material misstatements that you don't detect during your sampling, okay? And that could be a huge problem. So you need to determine what is the risk that we're willing to take? How much are we going to sample? What is the appropriate method that we're going to use for sampling? And that can vary based on all the other information. Now there's two things, right? First of all, there's a lot of objectiveness, right? So there is just looking at the account, seeing if there's deviation. Either there's a deviation or there's no deviation. But you can see when you look at this that there's a huge amount of subjective things that go into this, right? Like materiality, you can look at tables and part of that can be objective, but also what is an important account? Who gets to determine what's an important account? How do you define a risk as being very risky or moderately risky? Something like that, right? And so this is the part of the audit that there's a lot of research focusing around, because this is the crux of the whole thing, right? I mean, this is where the auditors are determining exactly how the audit's going to go, exactly what direction they want it to go, and more importantly, this is where the auditor experience plays the largest role. Because for the rest of the audit, it's just a matter of, is it a problem or isn't it a problem? They've already determined what constitutes a problem in the planning stage and what constitutes an acceptable deviation in the planning stage, right? They do all that here. So this is a really, really important portion. And they have what's called a risk assessment meeting and a planning meeting. And in that stage, the partner meets with all the team leaders from all the different departments of the audit team, or different groups of the audit team that are going to go in and audit all the different departments of the company. And they pretty much have a brainstorming session, and they discuss what potential risks might be arising, all of this information that you see here, right? That we're going to go into a little more detail about. So basically what they're doing is they're assessing the risk. So what kind of fits into all three of these is this idea of risk assessment, right? So in order to plan these portions, they need to evaluate the risk of all the different accounts. This is known as risk assessment, and it relies really, really heavily on the analytics that we've discussed. Because if you can look at an account that most auditors would consider to be low risk, and you do descriptive statistics on it, or you do a Benford analysis on it, and you see there's no deviation, it fits perfectly with the last year's data. All the predictive analytics that we've used say that this matches. Well, now you can say that that's a very low risk account. And determining the risk of the account is important because you use the risk assessment to determine how you're going to draw samples from that account. If it's a high risk account, you want to draw a larger sample size because it's more risky, right? You want to make sure that you have a higher chance of detecting a misstatement. But if it's a low risk account, then you may draw a much smaller sample size, or in some rare cases, not really test the account at all. If it's that little risk and that little materiality to the business, right? So that's the risk assessment. The tone at the top, right? This is something that the PCAOB and the AICPA and all these accounting organizations have really told auditors to focus on. If you ever take a fraud class or focus on fraud detection, this is like one of the number one ways that auditors like determine what the risk of fraud is and the risk of material misstatement is within the company. And basically what this is it's the tone set by management, and we're talking upper level management, over the operations of the company, right? These are some questions that you can ask yourself to determine the tone at the top, right? It is very intangible, but it does play a large role. So does management put profit above all else? If the answer to that question is yes, then there is a higher likelihood that there might be misstatements or earnings management that occurs in order to inflate the profit numbers. Does management consistently reinforce ethical behavior? If that's the case, then your likelihood of fraud is much less, because on a regular basis, they're reinforcing to employees the risks of running fraud, the risks that the employees are going to get caught, what consequences they'll face, and they're really drilling it into the employee's mind. So your fraud risk goes down a little bit, right? Then you know also, does it seem that management is helpful towards the auditors? This is a really big one, right? Oftentimes they teach you in fraud class that based on the interaction you have with the person, you can determine if you're going to find a problem within the company. If the management is very reluctant to help auditors and they seem like they have something to hide, then chances are they do have something to hide. It may not actually be fraud, but it could be some sort of management of profits that the auditors are going to red flag, that isn't being disclosed properly in the financial statements, right? So that's like a really, really important one. How willing are they to convey the requested information in a timely manner? So that's a pretty simple one, but you know that if they're taking a long time to give you information, they may be doctoring that information to cover something up, right? So with the tone at the top, as I mentioned, you can see like these all kind of pertain to fraud, but fraud is like a big issue, right? Because most misstatements, if they are just regular misstatements, you can detect them, they're pretty easy to correct, and the company's willing to correct it, right? With frauds, there is an element of human interaction with the data that is designed to conceal that. So some of the tests that auditors perform may not detect fraud. And that's a really serious concern because you might have a material misstatement in the company that you're not detecting. And that can cause a huge issue for the auditors. Fortunately, if it's a fraud situation, the auditors have legal protection because it was fraud. They did the best they could and it was hidden from them. But it is still a big concern by auditors. This one here, our company policies made clear to all employees, is a big one because not only is this targeting at fraud, but it also is targeting all the other areas that auditors are trying to review, right? One thing that Sarbanes-Oxley requires is that auditors go in and assess internal controls. As I mentioned before, internal controls are controls that are put in place to ensure the accuracy of data and that the information being entered into the system meets certain requirements, okay? There can be all sorts of types of controls. Management actually under Sarbanes-Oxley is also required to assert that all of their internal controls are operating effectively. That's part of what happens in a financial statement these days. So if you're making the policies of the company clear to employees, then there's a much greater likelihood that those controls are actually being followed by the employees because they have a knowledge of what the controls are, how they're supposed to operate, and not only how they're supposed to operate, what they're designed to achieve, right? If you don't really make these clear to employees, then you have employees who aren't even, they may not want to violate controls, but they may not even be aware that a specific control is designed to be in place. They may have no idea why a control is there, right? And if they don't understand these things, the likelihood of employees actually following these controls is much lower. And also, the likelihood of employees finding fraud amongst other employees is also lower. Because if they don't know why the control is in place, they don't know the way the business process is supposed to operate, then how are they supposed to know if someone is violating that process and committing fraud, right? And then finally here, what types of accounting methods are used? This is something they don't really need to ask management, but it kind of sets a tone for the way that the company acts, okay? If they use very aggressive accounting methods that are designed to inflate profits and things like that, for example, we spoke about how the airlines can sometimes use aggressive depreciation methods so that they can write off their plane expenses, and then in years of low profit, they can sell the plane and claim all of the sales as a profit. That can tell the auditors something about the way that the company wishes to conduct itself within the context of the business environment, okay? If it uses very conservative accounting methods, then obviously accounting is a very important thing for the business to focus on, right? And if it's important for them to focus on, then the likelihood of them doing these other things like conveying this information to employees, working with the auditors really well, all of these things can add up to an audit-friendly company that may have very little to hide, that may present very little risk to the auditors, okay? So pretty much, they need to establish what the tone at the top because it kind of gives them the direction to go in for the rest of the audit. Are we going to audit them very aggressively? Are we going to focus a little less on certain accounts and on other accounts based on the accounting practices that are used for those accounts? And how are we going to interact with management over the course of this investigation? Because, for example, you might detect fraud, and if you have a management team that is very willing to work with the auditors, that has very little to hide, you know that you can count on them to work with them to uncover who the fraudster is. But you may not have that liberty if you can determine from the tone at the top that management has something to hide. They may be involved in the fraud as well, all right? So that's something very, very important to consider. It's designed for the audit planning stage, not only for how they're going to conduct the audit, but how they're going to perceive the risk of fraud. Fraud's like a big thing, and that's really why they look at the tone at the top. Then what they do is they look at important accounts and establish materiality thresholds, right? So every company has different types of accounts, and some might be risky and some might be less risky, and they have to be audited in two different ways, right? So which ones are important enough to make a large difference refers to the materiality of these different types of accounts. For example, if you have an account with a balance that's only a couple $100, and you're looking at a company like Walmart, then auditing that account is a very, very low priority, because even if that account is materially misstated then the likelihood of a material misstatement occurring in the grand scheme of the financial statement is much lower because it's only worth a couple $100 at most, right? So with reference to $200, a $50 misstatement is definitely material. But that $50 misstatement within the scope of the million or billion dollars that Walmart is earning is totally negligible, right? So that's something that they have to keep in mind. This also includes not only the risk of misstatement, but the risk of fraud, right? Because even if you have one of these low value accounts, if it's a high risk for fraud, then that, right, while like misstatement's important, but fraud can indicate a more systematic problem within the company. So that's something that you have to kind of consider at this point. And when they determine this materiality threshold, like is $50 material or is $500 material? There's a lot of factors that go in, right? So errors are obviously expected, but at what point does this error become big enough to warrant a serious concern or cause a material misstatement? So that's what you're trying to look at here when you're determining the materiality threshold. These thresholds can be overall thresholds that they're trying to determine, right? So if we only have $50 in each account, but that adds up over like 200 accounts, the next thing you know, that could be a material misstatement. Or they could be specific to each high-risk account or low-risk account, right? Because you may just have an account that is a high-risk account and it's worth 10% of your overall profit. A material misstatement can be different for that kind of an account than a smaller account or a less risky account, right? And this obviously involves a large degree of auditor judgment. So kind of for these areas of auditor judgment, this is where expert systems that we spoke about last class come into play. Because the idea here is that your audit partner and his group leaders are only as smart as their limited experience may be, right? To become an audit partner, I'm not quite sure how many years of experience you need, but I believe that it's like slightly less than 10. But either way, the point is you don't have the full breadth of experience that all of you combined do have, right? So these expert systems pool the knowledge of all the other auditors, all the other audits that have occurred in the same industry. As I keep mentioning, you're required to rotate out an audit partner every 4 years under Sarbanes-Oxley. So you can't develop a relationship with the company that might lead you to avoid detecting a misstatement, right? But there's a downside to that, right? Because the longer an audit partner works with the firm, the greater knowledge and insight they have as to what is normal within the firm and what is abnormal within the firm, right? So every 4 years you have a new person coming in, the new person has to reestablish the entire setting of what's going on. Fortunately, the way that most accounting firms have handled this 4-year switch is that after 2 years, what happens is you have a junior partner come in and serve on the audit for 2 years and then become partner, so that they've already worked on the audit for 2 years, even though they're not the official partner with the firm. So it kind of like circumnavigates the rule to a degree and allows them to get experience. But the idea here is to avoid problems with auditor judgment, you pool the knowledge into an expert system. The expert system is given to the auditors during this planning stage, and they're able to better draw conclusions as to what is a risky account, what is material for a different type of account, and this is the pooled knowledge of experience from all the other audits, right? Again, as I mentioned, you can't use other audit data on your current audit, right? That's illegal. So this is another way to kind of circumnavigate that. You're not using the data, you're using the experience, which is allowed, all right? So this is the problem with auditor judgment, because again, all of this is up to people's discretion. What is material, what's immaterial, what's risky, what's not risky. There's no way of saying this scores an 84, that's pretty risky, like that doesn't exist. I'm sure there's like risk indexes out there, but it's still subjective as to what constitutes the risk index number in the first place. So the next area of risk that they look at is this thing called sampling risk, right? So there's three kinds of sampling risk. But basically, sampling, it's as you all know, what we're going to cover today. Sampling is the process of selecting documents that can be used to support or deny any claim that is made by management, right? And the point here is for auditors to select documents from the population, so they don't have to test the entire population, but they can still draw statistical conclusions that say, okay, what management is saying about this account is accurate to whatever confidence interval they want. For example, we can say with 95% certainty that all the accounts in here are fairly stated as by management, right? They obviously can't say with 100% because that only occurs with full population testing, right? So they obviously don't do this. They have to determine sample sizes, and in order to determine those sample sizes, they need to weigh what the sampling risks are. And there are 3 basic areas of sampling risk, right? So the 3 kinds of risk that you run as a sampler are type 1 error, type 2 error, and non-sampling risk. I'm going to start with the bottom on non-sampling risk because it's the simplest, right? Non-sampling risk is the risk that you didn't sample something, right? Or you used the wrong parameters. And this can actually cause a failure to detect a misstatement. For example, if you have a high-risk account with large values and you mistakenly decide to use a small sample, and you say, all right, with 95% confidence, you can say that this is clean, but it's not, right? Because you have actually not sampled the correct data to allow you to draw that conclusion, right? So non-sampling risk is the risk that there's a problem that you haven't sampled, right? It's inherent in all sampling styles, right? Every single one has this because you're not doing a full population test, again, okay? Yeah?
Isn't that detection risk?
Similar to detection risk. Detection risk is the risk of actually detecting, but non-sampling risk is more the risk of, like, so detection risk is when you have plugged in the correct parameters as it was by the audit standards, and you've made correct assumptions, but you haven't detected the problem, right? So it is similar. In non-sampling risk, you're using incorrect parameters in the first place. Detection risk is totally inevitable, right? Even if you were to sample 99.999%, there's that tiny percent risk that you don't detect something. With non-sampling risk, the non-sample risk in that situation of 99.99 is almost non-existent simply because you can say that I've done the correct sampling procedure. There's no risk that I did the wrong sampling procedure, right? Type 1 error is the idea that it's like false positive, right? So you have something that you think that you've detected, so positive, but it's not actually an actual detection, right? Type 2 error is the inverse of that, right? You accept the idea that there's no problems, but in fact, there are problems that you haven't found, all right? One example of a type 2 error is big within fraud, because in fraud, you have a situation where there could be, all right, so we have a database, and it says there are 500 companies, and we found 5 frauds, right? That is subject to type 2 error, because there is a strong, or I don't want to say strong, there is a significant likelihood that within that sample of 500, there are actually 10 or 20 frauds, but you were unable to detect them, right? So they came up with saying like, okay, yeah, what we're saying is correct, but there are like there are examples out there that we weren't able to detect, right? With the type 1 error, what you're saying is we detected this as being fraud, but we were like actually incorrect in that assumption. So this is usually used in reference to hypothesis testing. So here you incorrectly reject the null hypothesis. So you're saying that what we asserted is true, but in actual fact, it's not true. The null hypothesis is the idea that whatever your hypothesis is, isn't. All right, so for example, if you have a hypothesis that all birds are blue, the null hypothesis is all birds are not blue. It's the nullified version of that, right? So when you do a population test, you may discover, based on your population test, that all birds are blue. A type 1 error would be that you say all birds are blue, but in actual fact, the opposite of that is true, right? For a type 2 error, it's the flip, right? You draw a conclusion that all birds are not blue, but in fact, all birds are blue. Does everyone get this? This one confuses the crap out of me too. So it's just a wording situation. But once you get used to it, it's a lot easier. Questions? All right. So these are the big sample risk issues. So when you're sampling, you have to come up with these considerations. So we're going to break up the sampling discussion into this portion, which involves sample planning, and then actually sampling the data, which comes later when you do the fieldwork portion of the lecture. Right? So you have the confidence level, right? The confidence level here is the level of risk that the auditors are willing to take that their sample is accurate or not, right? So you can never do a full population, but do you want to say with 95% confidence that this is okay? Or do you only need to say with 60% confidence? Because maybe the account is not very risky and is not very material, so it doesn't really matter, right? So that's the confidence level that you're trying to determine. This goes a long way in determining the sample size, because the more confident you want to be about the accuracy of the account, the more of the population you have to test, and the larger your sample has to be. After you determine the level of acceptable risk is usually when you determine how confident you want to be with the account and how large you want your account sample size to be, right? The next one is what's your estimated error? This is based on past audits of the same company. So usually within this company, for their accounts receivable account, we expect an error of about 2% in value, right? Just because there, as I mentioned, there are like common entry errors and things like that that occur. So we're expecting this amount of error. That feeds into the next one, which is what is the tolerable level of error? So based on this estimated level of error and how much we're willing to allow the count to slide, we are going to come up with some sort of materiality threshold. And that materiality threshold, combined with the confidence level, is really what we are able to draw our sample size based on. All right? So that all comes together in this kind of a chart, right? So if you have your desired confidence level, so this is the relationship, right? So it's direct. So the more confidence you want to have, the more sample you're going to draw, right? So higher, increase, lower, decrease, right? The tolerable deviation rate is an inverse relationship. So if you want a lower amount of deviation, right? You want to make sure that the expected value of the account is close to what you actually assume, like what you actually test. You want a higher sample size. Like for example, if you are expecting the account to be off by you're willing to tolerate a deviation of only $1,000 in a very large account, then you need to take a larger sample size because you need to be able to detect that small deviation. If you have the same large account and your tolerable deviation is much larger, like you're willing to say, all right, we're willing to have like $100,000 or something like that, then you need a much smaller sample size, right? Because your tolerable deviation is larger. Right? So then you have your expected population deviation, right? That's a direct one. So if you expect there to be a large amount of deviation within the population, you want to test more of the population. If you expect there to be a lower amount of deviation, you want to test less of the population. Where you don't, it's not that you want to test less, it's that you can test less of the population. Right? And then finally, you have your population size, right? So population size doesn't have a direct effect necessarily linearly with your sample size. I mean, it does. It's a combination of factors because the larger your population size, the more deviation you may have, the more expected deviation you may have, all these different factors. But directly, the sampling techniques that you do, you're going to see the sample table later on, it pretty much doesn't matter, right? Once you get over a certain number of items, then you're pretty much running the same population test. That's why I keep going on. Like you have this one company where they have 1 million manual entries a month, and according to the statistical sampling rules, their internal audit department only tests 20 of those out of 12 million, right? So they say that that's fine because we should detect it, and it's a low risk and all that kind of stuff. But I would argue that's not really fine, right? I mean, 20 out of even 1 million is still not enough, right? So that's this. you need to take into several key features, right? So how do you plan to sample? Like, what are you actually sampling? Is it an attribute? Is it a pass-fail situation? This is something like with internal controls, right? For internal controls, it could be something like access to a secure area. It's just a 1 or 0 type situation. Either you can access it or it's secure, right? If it's a monetary situation, you need to make additional determinations, like what is material, what is immaterial. You still need that for pass-fail because you still need to make sure that enough of the controls are operating on a global control scheme, but within a monetary unit thing, it becomes much more granular. Also, what is the scale of the account? What is the unit that is actually being sampled? What is the tolerable deviation, the sample size you need to define from all this information, and then you need to determine an expected deviation rate, right? Because you have the deviation rate for the entire account that you've calculated based on the past year's data and what you expect that to be within the industry, but you now have to break that down into what that deviation rate looks like within the scope of your sample. For example, if you have an account that is worth $1,000, right? We'll use a small and easy number. If it's worth $1,000 and you expect that account to deviate by 1%, right? 1% of 1,000 is $10, right? That's $10 deviation within the overall population. If you then take a sample size of 5, you need to break that down into the sample of 5. So within that five document sample, your 1% deviation rate, assuming that it's like $1 each, would be 50 cents. 5 cents. Sorry, 1% of, no. Yeah, 1% of 5 is 5 cents, right? So that means that if you have a sample of 5, like $5, then once you break a deviation of 5 cents, that has broken your overall rule of a 1% deviation within that account. Does everyone get that? All right. So that's a little bit about this. This we went over. So there are other types of tests that the auditors can choose to use if they don't want to do sampling, right? Because sampling isn't appropriate for everything. So some tests that they have to use are counts, right? Because you need to actually ensure that all of the inventory that a company says it has, it actually has, right? Again, there's expected rates of deviation that fall into this because even though a company has the best controls in the world, items fall off the back of the truck, so to speak. People walk out with extra bits of equipment that the company doesn't see them stealing, right? If you operate a retail store, people are going to steal from your store, right? So you expect some amount of deviation within the inventory, but that has to be acceptable. So for an inventory count, literally what happens is the auditor goes into the warehouse and counts the boxes, all right? Now, what we're working on, one of my colleagues does drone technology for this, right? So what they have, the auditor still technically has to be present, but what they'll do is they'll attach RFID tags to each box, and then they'll fly a drone around, and that way they can conduct an inventory count much quicker. Again, there are additional tests that have to be considered here. For example, what happens if there's multiple RFID tags on one box? Well, the solution would be you map it out geographically, and if you see a lot of tags in one location, you know that they're probably all stuck onto the same box. Additionally, there's a concern that, and this feeds back into sampling, there's a concern that even if I count the number of boxes on a shelf, what happens if one of those boxes is actually empty, right? So again, they use sampling to determine that. They say, what is an acceptable rate of deviation? What should our sample be? And then they literally open up the boxes of the sample and they test it. Or in the case of oil drums, they dip a stick in there and they make sure it's oil with the whatever octane level they're claiming it to be, right? So these kind of feed into one another, but it's a separate type of test, right? You count inventory, you count pieces of machinery, right? These are all assets that the company claims they have. If they have to liquidate them, then you need to make sure that it's there to be liquidated, okay? Operation sites, are they actually operating in the same number of locations that they're supposed to be? Now, I have a really great story on these because my original auditing professor from way back in the day, he was like a large guy, but he was really, really nice. And he said that he used to do auditing, and he found, after years of auditing this client, what they had been doing was they operated several different warehouses, which they claimed were all stocked with inventory, right? And the auditor had developed a really strong working relationship with this company, right? And so what was actually happening was they had these warehouses. The auditor would drive by and see that warehouse and say, okay, good, right? Why would they just have an empty warehouse? Well, they did actually have empty warehouses. They only actually had one warehouse full of things, right? Then what happened was they swapped audit partners on the audit engagement. So the new auditor wanted to actually go in and see what was in the warehouses. And so the company gave him this whole long story about how he couldn't access a different warehouse or something like that. And he was given the whole runaround. And what the company actually did for 2 years in a row on their audit until this was discovered was the auditors were only able to see one warehouse per day, and they were shipping all of the goods from warehouse to warehouse to cover up the fact that they only had one warehouse worth of stuff, right? Then eventually what happened was the auditors were like, you can't keep fooling us with this construction, we need to see multiple warehouses in a day, and they discovered that several of the warehouses that they claimed were full of inventory were totally empty, right? So they ended up getting dinged, and that was a big deal for me, right? Because it was a big client, they ended up losing it, but you can't just do that, right? So that's with the inventory counts. Then you have reperformance, right? What reperformance is you actually reperform what the people are doing and make sure that they are following the procedures correctly. Whatever accounting methods that they're using, are they actually implementing those accounting methods? For example, a company says on their books they use LIFO, last in, first out. That's the way they're accounting for their inventory. But if the accountants are actually using FIFO, first in, first out, then that can throw out the book value of the company completely, especially if you have inventory in something that is totally volatile, right? So this requires you to pretty much retest or redo the significant accounts that are determined by the auditors, right? They reperform the tests to make sure they're operating effectively. This also includes internal controls. For example, instead of just saying that a security door works, you actually reperform the task of testing the security door, right? Does it actually work? Does the login information for a computer system actually work correctly? And the idea here is, again, that you're just verifying that the procedures are in place and that they're being used correctly, okay? Again, same professor, he had like all these great anecdotes that I'm gonna give to you guys. With reperformance, detected a huge fraud that was going on in a municipal district, right? They had this old lady who was dealing with the expenses of the municipal court, right? And for years they had been conducting this audit and no one ever thought to question her. I mean, she's just the old lady, like what could she possibly be doing wrong? When he reperformed the balancing of the accounts, he actually discovered that not only was she using the incorrect accounting method, but she was actually skimming money off the top. And when they went back and they traced this, she'd been doing this for like over a decade. She had amassed like a huge amount of money, right? And needless to say, she got fired and arrested, even though she was old. And they didn't lose the audit engagement, right? Because the municipality was shocked that this happened. They were also like happy because they recovered they didn't recover all of it, but they stopped losing all this money, right? But this is how reperformance can actually detect some of these problems. Until then, no one had thought to reperform the task. Until then, nobody had thought that it was a significant account, or more importantly, they had misassessed the risk of the account because they assumed, old lady, what's she gonna do? We don't really need to reperform her test. Okay, got it? All right. The next one is confirmations. This is a completely unique one, and this is designed to detect fraud with business to business and business to client situations. It's a little less common for business to client because client transactions with the business are usually very low, like low value, like repetitive with different clients and things like that. But it's mostly for business to business. All right. And the idea here is that you're confirming what your audit client is telling you in terms of contract values, trade values of commodities that you're buying from them, and all that kind of stuff. And literally what you do is you draft a confirmation letter and you send it out to all the different vendors that the company has contracted. And you ask them, can you please confirm for me the length of your contracts, the value of your contracts, the different terms of agreements for re-upping, renewing the contract, what types of voidable actions can occur, or actions can occur that would cause you to void this contract, because that's determining the going concern risk of the company, right? So they send out these letters and they find all this information, right? Like, for example, like shipping details, right? Because the company is saying this is how we account for shipping. Is it like once it leaves the dock at the other company, or is it once it arrives at our shipping dock, or is it even after that once we've evaluated that this is indeed the good that we've received? That's all also included in the contract as when you actually pay the other company, right? So it verifies all this information, and if they don't get back in the confirmation letter, they'll call them up and try to find out. Obviously, this doesn't work 100% of the time. Not everyone gets back to you. There's not much an auditor can do about that. But for the most part, confirmation letters are received and responded to, right? You need a representative sample to be returned in order to draw the conclusions during this test, right? If you send out like 1,000 confirmation letters and you only get 2 back, you can't say with any degree of certainty that in fact the company is not lying about the contractual information they're providing. The other thing here that it's not the primary purpose of the test, but that they use in this test is to determine that the companies are not dummy companies, right? Sometimes what will happen is to commit a fraud, an employee will make up a company and start sending checks out to that company, right, as payments for goods that they're not really receiving. And in a large company, this might go unnoticed. But with the confirmation letters, if year after year you're sending a confirmation letter and making calls to a company that doesn't come back, then you can determine like this is a high risk account with the company. There's a lot of money going to it. It's in recurring payments of regular amounts. There should be some working business relationship with it, and we need to see more communication between the 2 companies. Another thing that they look at when they do confirmation testing to try to detect this kind of fraud is what is the actual address being presented by the company, right? Chances are, if it's like one hacker way, then okay, yeah, it's probably like Facebook or some Silicon Valley company. If it's a sketchy P.O. box in a city that's almost unknown to people, then there's a high likelihood, right, that it may be a dummy company. Auditors do pay attention to P.O. boxes, right? Like, it's told for fraud examination that if it's a P.O. box that you're mailing confirmation letters to, that there's a likelihood that that is probably going to be a dummy corporation that you need to investigate, okay? So they look at this year after year. They develop a working relationship with the clients. Another thing that they do in lieu of or in line with the confirmation letters is a similar test called, I believe it's a 1033A, right? And what that is effectively a confirmation letter that is sent out to a third-party contractor for the company. In this situation, what you're looking for is that you might be auditing a company, right? And you might be saying that all of these internal controls, all of these processes that the company has in place, all of the accounting that they use, all of the security aspects that they have in place, they're all great, right? But what good does it matter if you have the most secure network in the world if you're outsourcing your cloud data to a third-party company that has no security, okay? So what this form is required. If you have any third-party interactions like that, that all of your third parties have to send you this form. And the form comes from their auditor. And it says, okay, we audited them and we found no issues, so you can rely on the fact that this company is audited to the same level of standard that you're currently conducting your audit with, and as far as you're concerned, this portion of the audit is already taken care of, right? Because obviously you can't just go into a third-party company and start auditing them. That's not an option for auditors to do, okay? So that's what that form is. We should probably add a slide about that for you guys to review. But anyway, so that's similar to a confirmation letter, but it's not exactly the same. all right? Because that's also mandated by law. Confirmations are mandated as part of the audit, but it's a little more like fuzzy, right? Because not every confirmation letter is going to come back in the mail, all right? But with this form, it's required, right? So they already know if they're a business that operates like this, their auditors are already drafting this form and sending it out to their clients and things like that. So once you've done all that, you move into the fieldwork portion of the audit, right? So this is the format that you follow with all of those tests that we just discussed. You plan the tests, you come up with all the different parameters that you want to use, all that kind of stuff. You perform the test, you actually do the sample, draw the sample, you do the inventory count or something like that. You evaluate the results to see if they were within the acceptable thresholds of failure, and then you document it. This is super important. I can't emphasize it enough, that's why I put it in caps over here, right? Auditors have to document absolutely everything that they do on an audit. It's absolutely crucial. It's required, right? Legally, it's actually required. And it minimizes the exposure to litigation on behalf of the auditor. As I said several times this semester, when a company goes out of business, the only person left to sue is the auditor. And they always want to come after the auditor because the auditor was technically a third party with unadulterated access to all the company information they want, and they said there's no problems with the company. Or if they said there was a problem, they specified the problem, all right? If you don't document what you are doing, then when it comes to getting sued, you are negligent. People can actually go to jail for this, okay? So you need to make sure that if you're conducting an audit, or if you're working on an audit, I doubt this is a problem in the Big Four, I doubt this is a problem in most audit companies. If you are doing something on an audit, and someone is not documenting it, you need to tell your boss, because that's a huge problem, okay? There can be all sorts of issues with this. They could be conducting the test incorrectly. Then if it's documented and the boss sees that, they know the test was conducted incorrectly. They could be conducting the wrong test, which would be documented. They could be doing everything correctly and missing fraud. And if that's not documented that they did do everything correctly, then guess what? You're complicit in that because you may have done something wrong and try to cover it up. They don't really know. So unless you have it documented, you can't prove otherwise, all right? So pretty much what you're doing in this portion of the audit is you're actually conducting what most people would consider the audit, right? Where you're going in, you're doing all the different tests, you're running all the analyses, you're still communicating with management, right? Because you still need access to the information. You're running all these tests. You still need to get into the warehouse, right? Hopefully they have security in place that prevents people from just walking in and walking out with inventory. So you need permission to circumnavigate that. You need, a lot of times, big clients, I have a lot of friends in the industry that tell me this, that they have like way too much stuff to carry around because the clients, they're very like, with all these like data breaches, they're very like uneasy about giving the auditor just data. So they give you the data, but they give it to you on like a company laptop, right? I don't mean like you work for Ernst & Young and Ernst & Young gives you a laptop. Like yes, they will do that too. But I mean like you work for Ernst & Young, you're auditing Microsoft. Microsoft will also give you a laptop with all of the data that you want on it, right? And so they know that up to Microsoft standards, their data is secure, okay? So this is kind of what you're doing at that portion. You're interacting, you're gathering the data, you're operating the tests, you're evaluating and retweaking the tests, you're sort of at the end of the field work process, you're communicating with management what some of the problems are, and hopefully they're reworking it, and you're going back and you're retesting to make sure there's no other issues, all this kind of stuff. All right? So all the tests are performed. Oh yeah, I forgot about this one. So auditors conduct interviews with key corporate individuals. This is really important. Not only does this help reinforce the establishment of tone at the top, right? Because you could come into a company and you could totally misassess the tone at the top. Or for instance, you could come into a company, right? And the tone at the top by the upper level management is totally disconnected from the actual tone practiced by your lower level management. For example, the upper level management may believe very heavily in ethics, may feel as though that they're doing a lot to impart the importance of ethical behavior on the employees. But if your lower level management doesn't care about it and is telling the employees, hey, look, I need to meet my earnings targets for the big guy upstairs, that can cause you to reevaluate the areas that you're trying to audit and adjust your samples and adjust your statistical analyses of what is acceptable in terms of materiality, okay? So you're conducting these audits and you're conducting these interviews on the audit, and what you're also looking for in these interviews is you're looking for any evidence that internal controls are being circumnavigated by accident or intentionally without the knowledge of the employees, right? So you're asking employees, you may know that it's required for there to be 3 signatures on a document. You can go to the employee and you can say, okay, once you have this document, what do you do? If the employee doesn't say, go and get a signature, and you interview another employee and they don't say, go and get a signature, and all of a sudden you realize nobody's going to get a signature, then when you start auditing those documents, you may want to adjust the size of your samples or focus in on that particular internal control when you're looking at the documents that are supposed to have those signatures, okay? Or you also want to see, like, if all these employees are saying they're not going to get signatures and the documents do have signatures, well, maybe someone is post facto going back and signing them or something like that. That's illegal, okay? So this is what you have to consider when you do the interview portion of an audit, right? Other common tests that they do, this is a big one, the three-way match, right? So currently there's a lot of systems that are attempting to make this much simpler for auditors, because the three-way match used to be like the most cumbersome portion of an audit, and it is a really necessary test. And pretty much you have this account, right? Which is any type of company that conducts businesses with other companies, that purchases stuff from vendors. Even if you work at a steelworks factory, right? I mean, they still need to get raw materials from somewhere, all right? What you need to do is what's called a three-way match. And what you're matching is the information on the invoice that comes from the vendor that says, this is how much we're going to bill you for, all right? Then you have your purchase order, which is like, this is how much we requested from the vendor. And you have your receipt, which actually indicates how much you paid and for how many goods you paid that for, right? You need to match the numbers on all three of these documents. Not only do you need to match the numbers, first of all, you need to match that all three of the documents actually exist, all right? Otherwise, you can run into problems, failure of the test, right? So it used to be that you have to go to usually 3 different portions of the department, look through all the files. Hopefully they have a common numbering system that you can use to link all these documents. You by hand draw a sample, you examine them, make sure all the correct controls are on there. Like, for example, on your purchase order, does it have the correct signatures, okay? And once you've done that, you can say, based on your sample, okay, the three-way match test was successful. Now, fortunately, we have ERP systems which can allow you to do this a little easier from an electronic standpoint, right? All of these documents are electronic. All of them are entered into the system almost automatically, right? In the olden days of paper, you run the risk of losing documents simply from swapping file cabinets or moving from building to building, right? Here you have it all on a computer system, so it's easier to find. You just search in the system. And the nice thing about doing this on computer systems is if you wanted to, which unfortunately external auditors don't really, you can do a full population test. You can see, are there any documents that are missing anywhere in the population within this three-way match system, right? So the three-way match is like a big test. It's in every single audit, and it's important, right? Because this is a high-risk account, purchases, right? You need to make sure they're actually getting what they're paying for. So also there's a lot of analytics techniques that come into play here. For example, let me try to think of one of the techniques and how you use it here. Like, so you use like the predictive techniques more for the planning. For here, you use the statistical techniques. Oh yeah, so the ratios, right? For example, if you run your three-way match and you can see exactly how much inventory has come in, you can look at some of your other accounts and you can see exactly how much sales your company's made. So you can see how all the inventory has passed through the conversion process to sale. Then, when you go to do your inventory count, you know exactly how much to expect there, right? If you see a deviation in any portions of these, that can alter how much you expect in that inventory count. And by looking at these different ratios and how they compare to one another, you can see if there's some sort of financial mismanagement that's occurring within the company. Okay? For example, are they fraudulently inflating their sales? And you can detect that just by looking at the amount of stuff that's come in, the amount of stuff in the warehouse, and therefore the amount of stuff based on the sales price that should have gone out. Okay? So you can use your analytic techniques that you learn in this class at this portion of the audit as well. All right. All right. Let's talk quickly about drawing a sample, and then we'll take a break. All right. So once a sample size is determined, right, the selection of the sample can be done in several different ways. All right. The first is the idea of stratified samples. So you can either take a stratified sample or a non-stratified sample. There's different ways to stratify a sample. The idea with stratifying a sample is that you're breaking the overall population into subgroups. Okay? You can do that in a lot of different ways. You can either take it by value, right? So you can say that I'm breaking them into the following brackets, right? Entries that are between 0 and $10,000, right? Between $10,000 and $100,000. Then maybe you have a lot of entries that are in the $100,000 range, so you're breaking that up into like 100 to 150. Anyway, you get the picture, right? You can break it up any way you want, right? And the idea here is that you can either do it a fair stratification or you can do it based on the population distribution, right? So if you have a distribution that looks like a normal distribution, right? And you have $0 here and you have $1 million here, then you can break it up so that you have the same number of points, data points within each sample, right? So obviously your mode section is going to be much thinner stratification, and then your external sections are going to be much fatter, right? So you might break it up a little bit like this. So not every stratification is the same range, but you're trying to get the same amount of data in each stratification link, right? It could also be that you do want to take like an even sample of this, because maybe you're really concerned about these high value accounts at the top here, right? So maybe you have a distribution. Maybe you have a distribution like this. You take a thin strip in the middle, and then you also want to take a thin strip at the top because you really want to try to detect something that's misstated in this range. Okay, so you can break this up however you want, but the idea is that you're breaking up the sample into subsamples, right? And you're kind of drawing. You're breaking up the population into subpopulations, and you're drawing samples from each of those subpopulations, right? You're going to see that this is going to play a role in one of the other sampling techniques. So whether you decide to do a stratified sample or not, there's different methods you can use. So the idea here is a haphazard sample. You can think of this as a random sample. This is usually done when you're not taking a stratified sample, right? You're sampling the whole population. And the idea here is that you give every entry into the population a number associated with it, right? So say you have 1 million different entries, you give each number like 1 to 1 million, and you decide that your sample is going to be a sample of 50. So you use a random number generator to generate 50 random numbers, and once you've done that, you test those ones. So you could be testing entry 1, 2, 495, 3,000, anything like that. It's just totally random. So that's called a haphazard sample. It is an arbitrary form of sampling, and if you do this without stratifying your sample, it can actually unfairly sample portions of the population, right? In the example I gave you, if you're examining 1, 3, and then 495, well, if those are entered chronologically, that could be several months worth of data that you're not testing at all, where there could have been fraud, where there could have been a misstatement, or maybe there was a person that was working for a few months that was a new employee that got fired because they were doing such a bad job. That's something that you would never be able to detect if you do a totally random haphazard sample, right? So that's the big drawback. The nice thing is it doesn't suffer from auditor biases, right? Because it's totally random. So you could be testing big number of accounts, you could be testing little number of accounts, and theoretically, this is a pretty ideal statistical way of sampling because you're using the statistical proofs to generate a sample, and you're using a random sample to fill in what those sample data points are going to be, right? So the point behind using statistical sampling is you can say that there's a high level of confidence and you're experiencing no bias when you're picking the sample out of the population, right? So that's haphazard sampling. The other one here is an even distribution sampling, right? So you can do this in one of two different ways. So basically what happens here is you take the whole population and you divide the population by the total number of points you want, right? So if you have a population of 100 and you want to take a sample of 5, all right? So you divide 100 by 5 and you get 20. So what you decide to do now is you choose a starting point in one of two different ways, and you test every 20th point in the data set, all right? So the first way to do this is choosing it by, like, as the auditor, right? So say I just came in to do the audit, and I picked entry 49, right? So 49 becomes the first one that we sample. Then you go 20 more, so then it would be 69. Then you do 20 more, and it would be 89. Then you do 20 more, but then you're capped at 100, so you start over again from 0, so it'll be 9. And then you do the last one, which would be 29, right? So that's kind of how the even distribution sampling works, right? You have literally taken an even distribution of the total population. You know that between entry 0 and entry 100, or entry 1 and entry 100, you've gotten a test in for each one of those months of data, or whatever type of data you have entered in there, right? The other way that you can start here is with a random start. Instead of the auditor picking a number, you have a random number generator pick a number, and you do the same thing, right? You just jump around like this, okay? The problem with this kind of a sampling technique is it can suffer from a similar bias in that you may have a large gap, right? Like, so 100 divided into a sample of 5, that is a pretty good representation of the data, but this is like totally not what actually happens. It's more like 1,000,000 divided by a sample of, like, I don't know, even if you do a sample of like 50, right? Then you're doing 100,000 divided by 5, that's 20,000. So that's one record every 20,000 that you're picking, right? So it's still a large gap, right? So you could pick record 20,000. The next record that you're going to pick is going to be 40,000. So you can see that there's a large gap in the data right here. Now, hopefully, if it's 1,000,000 records that you're sampling from, this gap doesn't actually correspond to a large time frame, but it could very well correspond to a time frame. The other thing is, like, if you have a repeating fraudulent entry every month, then it's going to fall into a predictive slot, right? So if every month the second entry of the month, so in this case it would be entry 20,001, was fraudulent, right? Then next month, entry 40,001 is also fraudulent. Unless you particularly pick, either through the random number generator or as an auditor, the correct number to use as a starting point for your interval, you're never going to detect that fraud, all right? And that's a risk that you run with this. Now, granted, the likelihood of them getting it exactly as the second entry every single month when you're in such a large company is pretty low, but But even then, if it's 20,001 and 20,000 and 40,003, all right, it's the same problem, all right? You have slightly better odds in that case of detecting it because there's 2 start points that you could use that would detect that fraud, but it's still a problem. All right, so what I would personally recommend, if I was an auditor, but I'm not, I work here instead, is what's called a random walk. All right, a random walk is very simple. It's very similar to a haphazard sample. It's a combination of a haphazard sample with a stratified sampling technique. So what you do here is you break the data up into brackets and you take a random point within that bracket. So for example, in the case of it being like 1,000,000 entries and you want to take 20 samples, you can break it up into the $20,000 brackets that we had before, and you can, instead of the 20,000 entry brackets that we had before, and instead of just, or sorry, you want a sample of 50, right, in that case. Instead of just definitely picking, so your brackets are 20,000 to 40,000, right, and 40,000 to 60,000. Instead of picking like 20,000, 40,000, 60,000, 20,001, 40,001, 60,001, what you do is you have this in a bracket and you pick a random number somewhere in there. So this bracket's sample could be document number 21,867, right? And instead of it being over here as 41,867, this one could be 59 and 46, right? So what you've done here is you've kind of mitigated the issue with the even distribution sampling situation where a recurrent entry every interval is not detected because you're doing a random entry within the interval. Does everyone understand this? In reality, ideally, your interval is large enough so that your interval, you could say your interval is large enough or your sample size is large enough so that instead of just doing one random number in this range, you're doing a couple of random numbers in this range, right? That way you can crack down on the issues of it being pattern or missampling within a month. Like for example, the gap here is even more than 20,000, right? Here you're breaking it into 20,000, so you're saying the most amount of time between samples is the amount of time it takes to log 20,000 records. But in reality, when you're doing a random sample like this, your gap from 21,867 to 59,000 is like 38,000 about, right? So you're leaving a larger gap of window than your interval is supposed to indicate. All right? So that's the risk with doing the random walk sampling. But if you hopefully take a larger sample, then this doesn't really happen. So each of these sampling techniques has its drawbacks, right? Because they all have potential flaws. But the idea with this is that hopefully, you don't do the same sampling technique. Or if you do the same sampling technique, you use a random sampling technique, either haphazard or random walk, and management is unable to predict which kinds of records you're going to draw, okay? With the more predictable forms, management could learn the way that you audit their company, predict which kinds of documents you're going to audit, and try to circumnavigate that to hide any kind of fraud or something like that. Everyone understand so far? All right. This is the table that is used. I mean, each company kind of comes up with their own way of doing this, but this is more like there's like standard tables that smaller audit companies can use. So this is a statistical sampling table, right? So you have your expected population deviation rate here. So is there a high rate of deviation or a low deviation rate? And then what is your tolerable deviation rate, right? So are you willing to allow there to be a 20% deviation in the population, or do you want a much lower rate at 2%? So when you match those two numbers up, it gives you two pieces of information. What is the total number of, this doesn't have it on this, but usually if you look like in an auditing textbook or something, there'll be several of these charts. And the charts are determined based on what confidence interval you want. So you're determining on the 3 pieces of information that we spoke about before. Your confidence interval, your tolerable deviation rate, and your expected deviation rate, okay? And what it tells you here is the big number on the left, outside of the parentheses, is what your sample size should be. So you can see, the lower your tolerable deviation, the larger sample you need to draw the kind of conclusion that you want. So assuming that this table, because it doesn't tell us, oh yeah, it is. It's 95% one. It says 5% risk of assessing control risk too low. Okay, so this is with a 95% confidence interval. So assuming that you're using 95% confidence interval, you're expecting a deviation rate of 0.25%, and you have a tolerable deviation rate of 2%. You need to test 236 documents in order to draw the conclusion that there's no problems within this account. The number that's in parentheses is the number of failures acceptable before you cross that toleration threshold, okay? So in this case, if you test 236 accounts and you have 1 or less failure within that, or 236 documents and you have 1 or less failure within that, then it passes the test. The second you have 2 failures, then it fails the test. And usually what that means is you have to test the whole population now, all right? Because you need to understand exactly what that means. If this was a monetary sample, then that's not enough, right? So you know that you can only have 1 failure. But what also matters is the size of that failure, okay? Because it could be 1 failure, but the value of that failure is like $600,000, right? And if it's a small company, that's very, very, very material, right? So that's why for the monetary accounts, you come up with not only a failure rate for the sample, but also a failure rate in terms of the materiality threshold, okay? So when I said before, if you have a materiality threshold of $500,000 and you're testing only 10 documents, then your acceptable failure value is $50,000. So if you find 1 misstatement with $50,000, it may be okay here, but it fails your materiality test, and you now have to test the whole population. Or do another resample and determine if there's more failures within it. All right? So if you have a higher tolerable deviation rate, you can see, even if you have 0.25% of the expected deviation, and you are willing to allow a 20% deviation in the population, then your test only comes down to 22, right? Still only 1 failure. When you get higher to the expected population deviation rate, you can see down here, the numbers get a lot bigger, like 6 failures, 7 failures. There's even an 8 and an 11 down here, right? And this is because, right, you're expecting some natural failures within the system, okay? So the more natural failure you're willing to expect, then the more you can tolerate those failures. So even though this is a 10% level of tolerable deviation, you can still, within 179 documents, have 11 fail, and it's okay, all right? Because you're expecting 6% of those to be failures anyway, okay? Once you get above 11, then you have a problem. Does everybody understand how to read this chart and what it's trying to tell you, okay? So if you were to change the confidence interval of the chart, what it would mean was, like for example, if you want to say with only a 90% confidence interval, so a smaller confidence interval, so instead of it saying 5% risk of assessing control risk too low, it would be 10% risk, then these numbers for failure would be lower, and also the number that you're testing within the population would also be lower, right? Because you're willing to test less of the population. You've decided that it's a lower risk account, it doesn't matter as much, right? The reason why there's stars here is not because you just don't do it if it's at this rate. It's because whoever came up with this table, right? This is the AICPA. All right, so the AICPA, the American Institute for Certified Public Accountants, this is it, right? So this is what they recommend. And it says that if you are operating in one of these sections over here, then it's too big of a sample size for you to draw for sampling to be a cost-effective method of determining the accuracy of that account, right? That's up to them, but obviously not every company operates this way. These are guidelines, these aren't requirements, right? All that has to happen, if you work for one of the big four doing auditing, they'll have their own version of this table, right? All that has to happen if you're using a different version is that you document what table you use in the documentation portion of your audit. And that way, if something happens later on, you can go back and you can say, this is what I use. Oftentimes for these big auditing companies, there'll be a whole list of statistical reasons backing up their decisions to use that. And hopefully you can present it in a court of law and say, look, we did the best job we can. According to the statistics that we have available to us, we were able to say that within this confidence interval, for this set of tolerable and expected deviations, this is what we came up with. But for most small and mid-sized firms, they probably use this one or one very similar to it, because you don't want to mess it up, right? I mean, if you use the official one, then the chances of getting in trouble are pretty much non-existent. Next, we're going to go over evaluating sample results. Okay, so pretty much the idea of this one is you look at this chart, right, and you see the numbers, like I said. For non-monetary variables, it's pretty much a pass or fail, right? It's pretty much a pass or fail situation, all right? If it's a situation with the monetary values, like I explained before, not only is it a pass or fail, like for example here, right? If you're operating down here, you're allowed 11 failures, but it may very well be that after your first 2 failures, you've already exceeded the materiality threshold for your sampling test. At that point, you have to shut it down and test the entire population, right? To make sure that you're taking a representative sample. It could very well be, right? So your materiality threshold for the sample might be 100,000, might be 10,000, and your overall materiality might be 100,000. So if you're testing and you have 2 failures, and your 2 failures amount to 20,000, right? It's broken your sample materiality threshold, right, by $10,000. But it could very well be that when you test the entire population, those were the only 2 failures in the entire population. I mean, it's very statistically unlikely, but that could be the case. And if you determine that that's the case, all of a sudden the $20,000 failure in the scheme of your overall account materiality of 100,000 is negligible. So the account is okay. But you won't know that until you do your full population test. All right? So with the monetary units, it's not only number of failures, but value of failures. Okay? Yeah. So ideally you want to test the whole population. That usually happens, but not always. Sometimes they'll just resample and see if there's a better rate of success. And if you can resample enough times, then you don't have to do the entire population, right? You just need to prove, all right, with some of these things, there's not like laws that say you have to draw a sample size of this or anything like that. It's left up to the auditor's discretion. So as long as you document it and you can say that to the best of my expertise, to the best of my knowledge, based on common practices within the auditing field, I did what was appropriate, then you haven't done anything wrong, okay? Maybe you haven't followed the best practices, but you did the best that you could, and you can't be held legally liable in that case. All right, so let's take a break here. I guess we'll finish up with fieldwork problems, and then we'll take a break. So basically, these are some problems that you can experience when you're doing the fieldwork portion of your audit, all right? So obviously companies, they're required by law to help you out. They can't try to distract you from committing the audit. They can't hide information from you if you ask for it. Like I told you the story about the warehouse situation. Eventually it became a situation where the auditors were like, look, you need to let us in on the same day. That's part of our due diligence. If you're not letting us do that, then we can't issue you a clean audit opinion, right? So if they're trying to do that, then it's literally illegal. You can drop the client and they'll have to find another auditor that's willing to accept that. But obviously then they aren't doing their due diligence. They become liable for either being criminally negligent or fiscally liable for refunding the shareholders if they come knocking on the door of the auditor, all right? So if they don't do this, you can actually issue an adverse audit opinion. which is known as a qualified opinion. A qualified opinion basically says, hey, there was a problem, this was the problem, that's it, right? It's not like there was no problem, it was like, this is the problem. Sometimes it's a relatively minor one, but it's enough for the markets to react, and that will punish the company, right? And the whole point is for the market to know, is the company, again, is the company management fairly representing the company within the financial statements? Are they accurately and fairly doing that? And if the answer is no, you need to be able to say, this is why not. And even if you don't detect a material misstatement, you can still issue that kind of a thing because they're not giving you access to all the information. It's a really unfortunate one to do by management because they could have a totally clean audit, and simply by preventing the auditors from doing their job, they're going to get an unclean audit opinion, right? Then there are several other complications that could arise. So there's the inability to access information. This is why like drones are good. Like for example, if you're auditing a municipality and you want to know that the value of the bridges that they have, like for example, if you're auditing the New York, New Jersey Transportation Authority, and you want to know, they say, okay, the Verrazano Bridge is worth this amount of money. We've depreciated it this amount, and this is the likely amount of money that we're going to have to spend fixing it. The auditors kind of need to check that. So what does that involve? That involves literally going to the Verrazano Bridge and looking at the bridge and making sure if everything that they're saying about it is accurate, right? But what are you going to do? Are you going to climb up the towers to make sure they're not rusting? No, that's like a very difficult thing to do. So auditors are trying to find ways to do that without putting their lives at risk, all right? So drones are one way that they're trying to do it. By attaching a camera to a drone, you effectively get to see the whole thing without having to scale the whole thing, right? Because you have to remember, we mostly talk about the financial aspect of these things, but it's not just about numbers. It's about physical things too, right? And you need to be able to account for all of those physical things, all right? So you can also have voided documents. Like what do you do if you have a document that you draw in a sample and it's like a voided check? Well, you need to go and you need to make sure that in the company accounting books, the check is also voided, right? So there are voided documents, or you may have to also resample like that. Like document 20,001 may be a voided document, but that doesn't mean that it needs to count, that it gets to count towards your sample. You still have to, you got to make sure that the voided document is in fact voided, but you still have to take another document for the sample because you need to make sure that all of the valid documents are actually being counted for as being valid, okay? Missing or inaccurate documents. Okay, what happens if there's a signature missing? What happens if a receipt is missing? All right, that counts as a failure in the three-way match. But you need to know how to deal with that, right? And there could very well be an easy explanation for that. But that's something that you need to talk with management about and find out why that's the case. And one missing document is okay, but lots of missing documents is a red flag, right? And then the last one is incomplete or inaccurate confirmation. So what happens if you send out 100 confirmations and you get 2 back? Well, then you have to start calling up the businesses. You have to knock on doors, right? So these are things that auditors have to do. There's other things that an auditor can do. They can put in their audit report that, hey, we try to send out confirmations and no one was getting back to us. We try to call, we try to do all these things to constitute due diligence. All right, let me just explain this because I keep using this word. It just occurs to me that maybe you don't know what this means. Due diligence, right? For those of you that don't know, just means that you are doing the best job that you possibly can under the circumstances to do your job as correctly as possible, right? An example of due diligence is actually sending out the confirmation, right? You try to do it. The due diligence comes in when the documents aren't coming back, so you try knocking on doors, you try making the phone calls. An example of not doing your due diligence, looking at the contracts and saying that's good enough. Right? It's not. You have to do the confirmation. All right? Another example of it is none of the contracts come back, none of the confirmations come back, and you do nothing about it. You just let it sit, and you're like, oh well, tough. I guess we just have to assert that it's okay. Like, no, that's not okay. You have to follow it up. These guidelines are in place for a reason. All right? So these are some potential problems within the field work. Obviously, there's more. Like, you have to drill into all of these. Like, why are the documents voided? Why can't you have access to this? Like, if you don't try to do that, then there could be major problems that you're not detecting. Why are they missing? Why are they inaccurate? And why are they incomplete? All right. So these are all the things that you really have to consider when you're conducting the field work portion. And this is really important for you guys to know because if you go out and you work for an auditor, you're not going to be very involved in spending statements, right? I mean, maybe later on when you become partner or something like that, but you're going to be doing this, right? Like someone has to go count boxes or inspect the bridge, and you can trust and believe that that is not the senior partner doing it, all right? It's going to be you doing that when you get on the right? It's called grunt work. There's like less polite name for it too. So you need to know exactly what to do, right? I mean, there'll be procedures in place by the audit firm as to how to handle these kinds of situations, right? You have to go to your boss, you have to talk to them, they'll know how to handle it. Like obviously you don't go knocking on the manager's door saying like, what's going on, why can't I get this, right? That's something for the partner to handle. You have to remember that this audit is actually a business relationship, okay? They're paying you for a service. Actually, more accurately, the shareholders are paying you for a service, okay? Not management, they don't really have a choice. This has to happen, whether they like it or not, and they really don't like it. I can tell you that with 100% certainty, right? So you need to just keep that in mind, and keep in mind the fact that like you're infringing upon their day-to-day operations, right? People are not going to want to help you look through the stacks in the warehouse, right? They're not going to want you to. They're going to just leave you to do your own thing, and hopefully no problems come out of it. And this all like factors into the audit environment and loops back around to what we talked about before, tone at the top and the tone of the employees in general. Do they actually want to help you? Are they neutral? They're not trying to help you, but they're not trying to hinder you. Or are these problems coming up and they're making a lot of excuses? They're trying to avoid you getting to see these things. There is a lot of inability to access information, and it's continuous, okay? So these kind of things you have to keep in mind. Gone, you've planned the audit, you've conducted the audit, you have all the results that you've evaluated. Usually throughout all of this, as you're detecting problems, you're communicating with management, depending on what types of problems you're detecting, and if you think that there's an element of fraud, all right? Assuming that there's no fraud, you're communicating those problems to management, and hopefully they're correcting the issues or willing to correct the issues as you're conducting the audit, all right? Prior to actually issuing a formal audit opinion, what you're going to do as an auditor is speak with the audit committee, right? That way, if there's any issues that have arisen over the course of the audit that maybe management isn't willing to handle and deal with, the audit committee may be able to say, all right, well, management's not right on this one. Maybe we need to fire a manager or rehire someone else, something like that, right? So you present all your findings to the management and to the audit committee, right? As I mentioned before, the audit committee is appointed by the board of executives from the membership, the shareholders, right? And the shareholders, they are themselves shareholders, but now there are requirements for who sits on an audit committee, and I believe there has to be one accountant that actually sits on the audit committee, as well as an independent member, right? And that's to try to keep those independent so that, again, the audit, the point of it is all to be an independent reference, okay? So they're trying to keep all these things as independent as possible so that the shareholders are getting a fair shot in the accurate evaluation of the company, all right? So this, out of all the analytic techniques that we've spoken about, makes heavy use of visualization, right? Because not only do we discuss that visualization allows you to read a story about the data, it allows you to tell a story about the data. And that's what you're doing here. You're using these visualization techniques to discuss what you found over the course of your audit, whether it be material misstatements or even immaterial misstatements. Maybe you found that there are no significant defects in internal controls, but there are some defects, some things that the company could do better. And you're trying to present that to the management so that they understand not only what those changes could be, what those changes could mean, and the improvements to the business processes that these changes can bring, okay? So pretty much what happens is at this point, management and the audit committee, they're given one last opportunity to make the changes that the auditor is requesting that they make, or give access to the data that the auditor is requesting access to, all right? And once this has been done, the auditors have formed their opinion, right? There's basically sort of like 4 different styles of opinion that they can have, right? They can either have an unqualified opinion, that's the best, that's that there's no problems whatsoever. They can have a qualified opinion, and that says, all right, we found a material misstatement within this one type of account, but it's not a pervasive problem throughout the entire the entire financial statement. Management wasn't willing to work with us on this particular misstatement, so we're publishing that kind of an opinion, just stating that. Then there's a disclaimer opinion, and the disclaimer opinion basically says, we did everything we couldn't find any problems, but there were some things that we wanted to do that we weren't able to do for whatever reason. Maybe management prevented us, or more commonly, there was some sort of hiccup within the business process that prevented us from doing that. And then finally, there's an adverse opinion. That means that there's material misstatements spread throughout the entire financial statement. Management wasn't willing to work with them, and that's the only choice that they have. But we're going to look into this in a little bit more detail. All right, so you issue the report, and these reports, which you're going to see, I'm going to show you guys examples. It's pretty much the exact same wording, copy and pasted, with a little bit of slight differences in it. All right, and that's not true. There's 4 types, but 5 if you consider it going concern. But I'll edit that. So the first one that we're going to discuss is the best for everyone. This is an unqualified opinion, right? These are issued when there's no major issues that were detected at all. No major misstatements. Obviously, as I keep mentioning, there's going to be some types of misstatements that you're going to find within a financial statement, but as long as those aren't material, it's not really a problem. Then the language that's in this opinion, which I'm going to show you now, indicates that there is no significant issue that was detected, all right? So in this particular case, this loads. Up. So basically what you can see here, this is like a slightly altered, but basically what you can see here is that it's basically an independent auditor's report. The management committee is taking responsibility. This is pretty much where management makes their assertions. This kind of language will be, so this example that you have here comes from Hong Kong, but it's not any different from what you would see here in America, right? So what you have here is them saying that as far as management's concerned, they can assert that the financial statements are fairly represented and that the internal controls are operating effectively, all right? This is important because this portion of the audit report is what actually holds management liable. They're going to assert again on their actual financial statements that, hey, we looked at this and we think that everything in here is fair, but here's the auditor saying we spoke with management, as far as they're concerned, they prepared this fairly and they don't know of any problems within the statement, all right? Then it goes through what the auditor's responsibility in this whole process is. Basically, we look through everything and we're issuing an opinion based on our audit. What does that actually mean? Basically, we have right here, this is the language, all right? We comply with the ethical requirements, right, which means that they're doing all the things that they're legally supposed to do, like rotating audit partners, no conflicts of interest, there's no situation like, I don't know what the exact timeline is, but I believe if you work in a company and then you go to work as an auditor, you're not allowed to audit that company, I think ever, but it might be after a certain number of years that you can. So the ethical standards, they came up with a plan and they performed the audit up to those standards that they're required to. They've done their due diligence, and basically within a reasonable assurance, right? Not 100% because they couldn't test everything, because no one ever does full population testing, but with reasonable assurance, they can determine that the financial statements are free from material misstatement, all right? Not that they're perfect, but that as far as the auditors are concerned, there's no material misstatements. All right. As you can see, there's no numerical definition of material. That is built into the ethical requirements that they have. Did they ethically come up with that correct materiality threshold as far as the best practices require them to? All right. And they're asserting that, in fact, that they did, right? So this is the portion that is legally binding that they did, in fact, do a good job on the audit. Then once you've gone through all of this, how they obtain, like what they do in their audit, they obtain the evidence, they look at the amounts on the financial statements that are being disclosed. They acknowledge over here that this is based on the auditor's judgment, and that includes the assessment of the risks of material misstatement that we went over, right? So they're saying, hey, look, this is just based on our experiences, the best that we can do, but they're putting a name on it, right? And that these misstatements could be due to fraud or error, okay? As far as they're concerned, they weren't able to detect those, which you're gonna hear in the next opinion paragraph, okay? And basically what you can see here also is that they talk about the internal controls and how the entity is preparing and representing those internal controls as well as financial statements is fair and accurate. And that's pretty much what you're going over here, all right? They also, oh yeah, I forgot about this portion. They also go over how appropriate the entity's accounting practices are, right? So this can actually come up in some of the later types of opinions that we're talking about. It may be that there is no misstatement, but up to industry standards, the auditor has an issue with one of the accounting practices that they use, right? So in that situation, you'll see how the opinion might differ a little bit. But that doesn't mean that there's any kind of pervasive error. It just means that they don't go with industry standards. They don't do what the auditors feel is the acceptable risk, is the acceptable method that manages that kind of risk. But that doesn't mean that they're doing something illegal, okay? And then basically they presented it based on the information from the management committee, and they've assessed the overall presentation of those financial reports as being fair and accurate, right? So they also say here, this is important, right? We believe that the audit evidence we obtain is sufficient and appropriate to provide a basis for our audit opinion. You're going to see when you look at the disclaimer opinion, this is not here. This is different, right? So this is one of the sections that will change. Because in that situation, they can't really say this, right? They will say that based on the audited evidence that they obtained within the scope of their audit, it is sufficient and appropriate to provide the basis for their opinion. But you'll see there'll be an additional disclaimer paragraph about what they couldn't access. All right? Down here, you have the opinion, right? This is what the whole thing boils down to. In our opinion, the financial statements give a true and fair view of the financial transactions of the corporation during the year ended whenever, and in the financial position of the corporation at that date for the corporation's cash flow for the year ended in accordance with the reporting standards, okay? This paragraph is going to look exactly the same for every single audit that gets this opinion by this company. The only difference is going to be the dates might change if they have a different fiscal year or if they're doing the audit at a different time, and the name of the corporation is going to change. In fact, not only is this going to look exactly the same, but just about everything else you've read in this entire opinion note is going to look exactly the same. They're going to change the company name, they're going to change the dates, but it will be a copy-paste. Because the lawyers spent a really long time coming up with this so that it's as legally, woe-free as they could possibly come up with. And that's why they're going to just kind of copy and paste it, right? Then at the bottom, they have the name of the company that is conducting the audit. In fact, their CPAs, blah, 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 address and date. This audit opinion is going to appear on the financial statements. And that way you know, when you look at the financial statements, who the auditor is, right? So this, for example, was the reason why Arthur Andersen actually went under, because guess what? They lost their ability to audit for, I don't know, I think it was 4 years, right? So that was a huge portion of their business. And then on top of that, all the companies that were being audited by them that weren't Enron were like, whoa, we can't have your name attached to our financial statements because people aren't going to believe them, right? So next thing you know, Arthur Andersen goes under, and we're down to the big four instead of the big five, all right? So this is what is an unqualified opinion. Do people have any questions on this one? All right. It's pretty straightforward, pretty simple. Basically, they're just saying, hey, we did everything properly, they were very easy to work with, and we didn't find any material problems. In fact, they may have found material problems, but if they resolve those issues before they get to issuing the opinion, then they'll still issue a clean audit, right? This is what's known as a clean audit. All right. So that's an unqualified one. Now we're going to go through the next few, and then I'll show you an example of each of them, right? So a qualified one is where the auditors can't express their opinion that the company received a clean audit, but that the misstatements that they found were not totally pervasive throughout the financial statements. So what they're going to do is they're going to say, look, we had some particular issue with management's representation of this data, right? Management refused to fix this issue for whatever reason, so we're saying that everything else is fine except for this one thing that we found, all right? And they'll specify it. Here, let me pull this up so you guys can see this. So, you can see how this is already starting to look pretty much the same, right? So they said, all right, we conducted the audit. This is when we had everything tested. We did everything in accordance with the real standards and practices. This is management taking responsibility over everything. This is, again, the auditor taking responsibility, what they actually did. It's exactly the same stuff that you saw before, all right? Down here is where it's going to start to differ. They're going to say here, right, first they're going to state the basis for issuing the opinion, then they're going to issue the actual opinion, and that's going to reference this paragraph. So here, what they've said is they've said the debtors shown on the balance sheet as this amount that's due from a specific debtor, right? And that particular debtor stopped operating, okay? The company has no security for this debt, so the debt is still outstanding, and there's nothing for them to collect. On that basis, since there's no security and no cash that was received, in their opinion, they should make a full provision for the impairment of that money, reducing their profit before taxation for the next year. So basically what they're saying is here is some company owed the money, that company went out of business, there was no collateral on that debt, it was a significant amount of money, significant enough for it to be material, and we believe that they should actually reduce the profit because of that loss, but they're refusing to do it for whatever reason, okay? They don't have to say why they're refusing to do it, but people need to know that they are refusing to do it, all right? So that's the specifics of why they're issuing this. Then they're going to give you the qualified opinion, right? This is also going to be a similarly copy and paste situation, because what you're going to see here, like, look, in our opinion, except for the effect on the financial statements for the matter described above, all right, the financial statements are properly prepared in accordance with all the required laws and procedures, and they're fairly representing of the health of the company, all right? So the rest of this is exactly the same you saw before. There's just this extra couple of sentences in here saying, there's a problem, we've described the problem in the paragraph above, it was enough for us to put under here, and pretty much like the rest is copy-paste. Everything else is good, all right? Then this little section down here, we obtained all the information we needed, the end, right? Name, company, CPA, usually the partner has to put their own signature here, their own signatures on there, address, date that is performed, okay? You can also get a qualified opinion, although it's a little more rare, if there's an issue with the way that the auditors were trying to conduct the test. So again, you see everything at the top is the same, and then you get down here for the basis for the qualified opinion, right? In this case, what they said is that there's a recorded turnover, the recorded turnover compromises cash sales, all right? There was no system of internal control that we could rely on for the purpose of the audit, and there was no other satisfactory audit procedure that we could adopt to satisfy us that the recorded turnover was free from material misstatements. So basically, what they're saying is, there's a bunch of turnover that's in cash. There were no internal controls to validate if those things actually happened or not. There was nothing that we could do to audit that. So we had to put some qualification on the opinion, because the value of this cash sales was high enough to be material, okay? Again, you see how this portion is different, but then the bottom is literally the exact same thing that they said on the last page, on the last example you saw. In our opinion, except for the effects of such adjustments, if any, as might have been determined necessary, we had the ability to satisfy ourselves in reference to the cash sales. The financial statements have been properly prepared in all material respects. Again, there might have been problems, but they weren't material, and it's in accordance with the correct laws. Then the rest reads exactly the same as the last one. Are there any questions about qualified opinions? Okay. The next one is disclaimer opinion, all right? this is when the auditors were unable to complete a portion of the audit. So in the last qualified opinion that you guys saw, the auditors weren't able to conduct a specific test, although they were able to say that some elements of that account were actually fair. In this case, there was an actual problem that prevented them from testing a material account, okay? This might be by management doing something intentionally, but more commonly, if you do see a disclaimer opinion, I mean, they're pretty rare, but if you do see them, it's more because there's a like some natural reason why this occurred, all right? So in the example that you're gonna see, it's pretty much, for instance, right, like, say we buy 10,000 tons of coal right at the beginning of the year, and we burn that up to make our goods in the first couple of months, and by the time the auditors sign on to the audit engagement late because the company swapped auditors for whatever reason, and by the time the auditors get there, all the coal has been burned up. So there's literally no way for them to go and check if they actually had all that coal in inventory that they were claiming that they had at that point in the year, right? So because of that, the auditors can say, look, everything that we tested was fine. We found no material misstatements, but some of the information that they're presenting, we were not able to actually access, and we have to issue a disclaimer for our own legal protection and for your own knowledge that this portion of the financial statement may be misstated. We don't know, all right? And pretty much, so this is when the tests that are necessary, they're unable to perform. They're pretty rare, but they indicate that, like I said, they don't know if there's a material misstatement. In the qualified opinions, they believe that there's some sort of material misstatement, but it isn't pervasive throughout the whole financial statements. In this case, they have no idea, they're just not sure, right? It could be, it could not be, right? That's what they're trying to convey. So that looks like this. Oh, wait, okay, I forgot about this bottom portion here. So the other thing is this particular qualified opinion had to do with the testing that they did. So at the bottom, instead of saying there was no limitations, we got everything, they're going to include exactly what limitations they had, which you're going to see again in the disclaimer portion, right? So this is a disclaimer opinion. So the beginning, it looks exactly the same. The director's portion, exactly the same. The auditor's responsibility, exactly the same. And then you get here the basis for the opinion. All right, so in this case, they were appointed on a specific date, like I mentioned, that was subsequent to the end of the financial year of the company, right? As a result, in this case, right, so they were appointed, maybe they swapped auditors in January, right? So the company's been operating for a whole month, moving around the inventory that they had in their accounts. So the auditors are responsible for auditing the statements as of December 31st. So the new auditors that came in at the end of January are completely unable to verify the inventory amounts as posted on December 31st. It's not possible. There's been a month of interchanging values, right? Even if they go to the book values, those numbers could be fudged. That's the point of even doing an inventory count in the first place, right? So what you're doing here is they're saying, all right, well, we got appointed late. It's no one's fault except for the fact that it just happened. We did all the auditing procedures surrounding that to test all the things that we could possibly test. That may include doing an inventory count based on current inventory to verify that the company is indeed doing the best job possible to correctly depict what their inventory status is. Maybe that means testing the internal controls for security features, that no one's stealing the inventory, okay? Again, they're doing all the associated tests, but they're not actually able to conduct the portion or the test that they really need to conduct to determine if that's a valid number or not, right? The balance sheet amount is also included to say, all right, this is how much they're saying it was. It's obviously a material amount, but we can't verify it. There's no other satisfactory audit procedure that we could do that we haven't done that could actually verify this number in some other way. And obviously we've obtained as much evidence as possible based on the inventories, based on the work in progress, and we haven't been able to get sufficient, but as far as what we can tell, there may not be a material mistake, all right? So, They say here that the adjusted figures may have a consequential significant effect on the profit or loss for the year on the net assets dated December 31st, 20, whatever, okay? And really what you're hearing here is them saying they're covering their behinds, right? They're saying, look, we did everything we could, we didn't find anything, but we need you to know that there was something that we couldn't do. And it wasn't because of the management or something like that, it was just a natural occurrence, okay? So then what they say here is because of the significance of the matters described above, they can't express an opinion on the financial statements as to whether or not they've been prepared in all material respects in accordance with the law, right? Because they can't say that it was definitely correct if there is such a material account that they weren't able to account for. But they can say that based on everything else they've tested, it all looks good, right? So they say what they say next, right? So that to the best of their knowledge and information and explanations given to us, they are accurate based on the books that they presented, right? Then again, with the last qualified opinion where they weren't able to access some of the information, you see that they've included at the bottom, right? In respect of the low limitation that was listed above, on our work relating to the inventories and work in progress, we've not obtained all the information and explanations that we considered necessary, and we were unable to determine whether the proper books of account had actually been kept, all right? So we tried, we couldn't do it. These are pretty rare, but they do actually exist, all right? And then you have the standard boilerplate at the end, the name of the CPA that's practicing, address and date. Are there any questions on these three types, qualified, unqualified, or unqualified, qualified, and disclaimer? The differences, similarities, it's all pretty similar. All right, the last one, which I don't think, oh yeah, so then the next one is an adverse opinion, which we also have an example of here. So an adverse opinion occurs when, an adverse opinion occurs when they find that there's a problem with the financial statement, and it's more than just a little problem. It's a very big problem, and management is refusing to correct the problem, okay? So these are also pretty rare because a lot of times there's three things that will either happen, two things, I guess. Either management will fix the problem, and then there won't be an issue. The audit committee might fire management, hire new management, and they'll fix the problem if the management doesn't want to fix it. Or what will happen is the audit team will get fired from the audit engagement or voluntarily leave the audit engagement, right? More often than not, it's a fire from audit engagement, right? What has to happen is the publicly held company, every time they switch auditors, no matter what the reason is, they have to file a public document that describes who they're switching auditors from and to, and why they're switching auditors, right? Unfortunately for the general public, there's a catch-all that they can always say, which is it was too expensive, even though that may not be the truth. But the very fact that they're switching auditors in the middle of their audit engagement will indicate to the market and the public that there's probably a big issue within the audit, all right? The chances of someone having an auditor for like 10 years in a row and then all of a sudden deciding it was too expensive after already agreeing to the audit fee is pretty low, all right? It can happen, right? I mean, it could very well be they had a few flare-ups in the sampling, and they have to go out and they have to do testing, and they need specialists because of some new law that came into effect, and it's just driving the cost up tremendously. But that's pretty rare, right? So a lot of times what'll happen, they'll fire the audit people because they don't like what they're doing, and they'll hire a new audit team in, right? And hopefully the new audit team will issue a better opinion. Even if it's not an adverse opinion, maybe it's a qualified opinion, okay? This is known as opinion shopping. It's frowned upon. How illegal is it? I don't really know. Have you ever heard of a company getting in trouble for it? I haven't, but they do. All right, they're not supposed to, but they do. All right, and the idea there is that they're willing to pay a little extra if the company's willing to do a little less, which is actually illegal, right? They're supposed to all perform to the same audit standard, but we all know that this isn't an ideal world, right? So the language in these kinds of opinions is pretty standard, right? Because They're not having to specify exactly what went wrong usually, but they're trying to say that this is like a big problem. And they're including exactly what areas failed on the part of the company's materiality spectrum and what types of accounts, right? And why they're receiving this adverse opinion, all right? So, I have to go all the way back there probably, but this is an example of your adverse report. So you can see already that it's a little bit different from the other ones. They're issuing it to all the shareholders to let them know. They're saying that they audited the company. This is the same, right? They're including the same responsibilities for the auditors and for the directors. So that part is the same because the responsibilities, no matter what the opinion is, are always exactly the same, right? And then you get to the basis of the adverse, right? So here what they're saying is they'll have a note here. Let me see if this one. Yeah, they'll have a note attached that it goes into further detail on the financial statements. Sometimes they'll include it in this, but usually this is stapled on, like if you have it in paper, this is stapled on top of the financial statements, or it comes before the financial statements. So if there's a problem with this, they'll include a note in the financial statements, and they're saying the losses, in this case, expected to arise from certain long-term contracts currently in process have not been recognized as expenses, right? So that's something that you're supposed to do. If there's going to be losses that you know are going to happen for whatever reason, you have to recognize that on your balance sheets, okay? And in this case, they haven't done it, right? They think, the management thinks, right? They give the reason for why the management's arguing against this, that this should be offset against the amounts recoverable for other long-term contracts. So maybe that there's additional money coming in from those contracts that should negate that. But that's obviously not within the best accounting practices, okay? So what they're saying is that, and then the expected losses on the individual contract should be recognized as expenses immediately as required under law. If the losses have been so recognized, the effect would have been significant, right? That's what they're saying at the end, okay? So the point here is they're saying, look, there is a huge material misstatement that will directly affect the financial representation of the company. Not only is there a misstatement, but it's a misstatement for an accounting mispractice. And that accounting mispractice is something that management is not willing to budge on. So we have to let the market know that management is misaccounting for this kind of information, okay? The adverse opinion comes under this section. So they're saying that in reference to the basis, this is a very significant effect, right? And that way, and therefore we have to issue an adverse opinion, right? The financial statements have not been properly prepared. That's the whole point of an audit, right? To make sure that the financial statements are properly prepared and they accurately reflect the health of the company. In this case, they don't, okay? In accordance with the law, that is the case, and we conducted it based on this. The other portion that is the same as the qualified opinion that you saw, or unqualified opinion, is this section at the end. They did obtain all the information and the explanations that they required. So management didn't hinder the investigation. They gave an explanation for this accounting malpractice. It was an incorrect explanation, but they did give an explanation nonetheless. So that's going to be noted in the bottom, all right? Then they have blah, 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 corporation, the names of the accountants, the address, the date, all right? These are very rare for the reasons that I listed before, all right? People don't want adverse opinions. The effect of these things on your company's value is pretty tremendous, okay? It can also have legal ramifications. If you're illegally accounting for things, the law can come after you, all right? There's a reason why we have laws about these things, all right? I know it's generally accepted accounting principles, but there are laws behind some of these things, all right? Are there any questions on the adverse opinion? All right, the last kind of opinion that you can have issued is a portion of, it's not actually a type of opinion, so that's actually incorrect for me to say, but it is, but it is attached to the opinions, okay? And this is what's called a going concern opinion, all right? It says it's a special type of opinion, and it is, but it's also not really a separate opinion, right? Like you can get an unqualified opinion with a going concern attached to it, all right? What a going concern indicates is that the auditors who audited the company have determined that the company is likely to go bankrupt within the next year, usually because their liabilities aren't able to be covered by their assets, okay? This doesn't mean that they found a misstatement. I put it in bold and underlined it because it's kind of important to know, all right? They may have found a misstatement as well as issuing a going concern opinion, but they may have not found any misstatement. The company might just be performing very, very poorly, all right? This is like a huge issue within the academic field, right? Because going concern opinions became a thing not that long ago, and with the passage of Sarbanes-Oxley and the Dodd-Frank regulations, there's more pressure on accounting firms to issue going concern opinions, okay? The other thing is that since the invention of the going concern opinion, there's a new element of liability that an accounting firm faces when they're auditing a client. If they don't issue a going concern opinion and the company goes under, they could expose themselves to litigation from the shareholders, because the shareholders might turn around and say, hey, you audited this company, how the hell did you not notice that they were like literally months away from going in bankrupt, right? Now, it is possible that severe management actions within those couple of months turned a well-performing company into a bankrupt one, but the likelihood of that is pretty limited, all right? But there's two sides to this, okay? Because there's been a lot of research. So since like Arthur Andersen went under, since the Great Recession happened, all of these auditors are starting to get like really sketched out, and they started over issuing going concern opinions, right? And a going concern opinion, actually, if I recall correctly, the statistic is that if you issue a going concern opinion, the date that that opinion hits the stock market, the company's value will go down about 8 to 10% in value, right? And that's pretty significant. So it becomes almost like a self-fulfilling prophecy. Even if the company isn't actually a going concern, then if you issue an opinion, shareholders might react to that, lenders are going to react to that and call in loans, and it may actively affect the performance of the company when the company might just be healthy, okay? And this is like a huge deal because I think something like only 50% of, this was done in, I believe, 2007, this study that I'm citing, but only 50% of the companies that they studied that went bankrupt received going concern opinions, right? And that's type 2 error, right? A false negative, in that you've said that the company doesn't have a going concern opinion, but in fact it does. Then, on top of that, something like 65% of the companies that they surveyed received going concern opinions and did not go bankrupt in the following year. That's an example of a type 1 error, because what you've done there is you've said, okay, we've rejected the null hypothesis, this does have a going concern, but you were wrong, it's a false positive, okay? So those are pretty startling numbers, right? To be wrong 50% of the time when you're supposed to be right, and when you're guessing that you should be right, and 60% of the time, 60+% of the time you're actually wrong, that's like pretty devastating. So why doesn't anybody do anything about this? Well, there's nothing that people really can do about this. Either you make it a stricter law that issuing a going concern opinion has to fulfill a much more finite set of circumstances, but then you run the risk of defeating the purpose of the going concern opinion, right? A going concern opinion, as I mentioned before, is that a company is more likely than not going to go bankrupt within the next year, all right? It's not with any degree of certainty, but it's more likely than not. And the purpose of doing this is to notify the general public, all right? To a degree, it's to notify all investors, because the auditors have access to all the financial data within the company, and they have a much better platform for making this determination as to the accuracy of the ability for the company to stay in business for the next year, because they have all the financial information, right? But on top of that, like savvy investors, right, they can deduce a lot of these things on their own. They can't access all of it, but they can deduce a lot of these things on their own. This is more intended for your layperson investor who doesn't know as much about the financial information, who isn't necessarily able to drill down into these kind of investments on a daily basis the way that the savvy investors do, and may not be able to understand that their investment's about to go bad, right? Granted, just by issuing a going concern opinion, the value of the company is going to go down about 10%, so they're still going to lose some money, but it's better than losing all of their money, okay? So you have this problem, right? So you have the companies who want to cover their backsides, and they want to issue going concern opinions left, right, and center, and they do. The numbers of going concern opinions have started to skyrocket, okay? So what do? You make it tighter, so then less get issued, but then you're missing more. Or do you make it looser? Do you change the definition of going concern opinion so it doesn't have as much of an effect on the way the company performs? Well, I don't know, but then you're kind of defeating the purpose of giving a going concern opinion. You're not educating the people as much about what's going on. So this is kind of a very hotly debated topic in the field of accounting academia. There's a lot of research that goes on about this. There's a lot of research, as I mentioned, about not only the accuracy of a going concern opinion, because everyone is universally accepting the fact that they're very inaccurate. They miss a lot of bankruptcies, and they also get a lot of companies that aren't going bankrupt. But also they're looking at like what the requirements that these auditors use for being going concern, because that's an element of auditor judgment, right? The auditors are the ones who decide for themselves what it means for the company to be likely to go bankrupt in the next year. There's no standard for that, okay? So there's a whole branch of research that's just looking at trying to formalize the actual amount of data. But you know that's very difficult because companies operate at different sizes, right? There's a lot of like startups. So if it's a startup, you just automatically issue a going concern opinion every year. Like that's not appropriate either, right? There's also a high number of companies that get issued going concerns year after year after year. So is that an appropriate use of going concern, or is it an inappropriate use? Because obviously the company's floundering, but then it's also lasting for several years in a row. So when can you predict that it's only got 1 year left to go? All right. So that's the deal with this one. Are there any questions on adverse opinions? Going concern opinions, qualified and unqualified opinions, or disclaimer opinions? I think that's the end of the slideshow. All right, so that's the end of class for today.